We've got Nitin Bhasin as well joining in on the show. Nitin heads the Institutional Equities at Ambit, joins in on the show right now. Nitin, hi, good to have you on the show. I guess the markets now have a continued wait and watch mode because the tariff deadline's been shifted now to August 1st, and we haven't heard anything conclusive. While we understand that there is a mini trade deal which has already happened, but the big letter, so to speak, is still awaited.
Thanks for having me on this show. You're right. I think market is stuck at a phase where, along with flows and along with the macro indicators, we're just trying to find new direction. Where to go. Perhaps tariffs is one thing. India has become in a reasonably valued place where most of the stocks appear to be reasonably valued. So hence everybody's looking for direction from what happens on the tariffs. You're right, because Indian earnings, which we can discuss, but Indian earnings are not holding up. So because of which people are looking for the tariff event, how it plays out for us.
When you say Indian earnings are not holding up, are you talking about the earnings season which we should anticipate and expect for the quarter gone by? Or are you talking about the things which have already transpired in FY25?
So I think FY25 is behind us, and as we entered into FY26, in my last 10, 15 years of tracking the Indian markets, we've never seen that we have started a fiscal year with 9 to 10% earnings growth for the Nifty expected for the next 1 year. We Indians have, or most of the sell side has the penchant for estimating high amount of growth and then going through downgrades, barring the period post-COVID. But in FY26, we had an earnings growth of 9 to 11%. As of today, if I look at Nifty, I think the consensus estimates is more like 7-8% for FY26. Last quarter, we've seen another perhaps 2.5-3% earnings downgrades, primarily because of BFSI and some bit of healthcare. So hence, earnings are not giving the best visibility, but perhaps you could consider that as a contra signal also, some of the market players, that how low can it go. But I think that's what I was meaning by when next 1 year earnings doesn't look like we are at a very exciting state of earning expectations.
So if flows are strong, earnings are not great and valuations are rich, what will happen to markets?
I think we've been maintaining this, that India has a very big fundamental playing in its favor, which has been flows. Whether it was retail flows, whether it was the earlier about year and a half back or so, foreign flows, and now the flows from the other DIs beyond MFs, which is the UPS, the EPFO flows, and you can see that the mutual fund flows have been following the low returns from the mutual funds, and the mutual fund flows have come off, not have decelerated. But at the same point in time, the DI flows mainly from, you could say, the non-mutual fund institutions has actually been holding up. So flows has been driving the market, keeping the valuations punchy. And we see from the bottom in the last 3 months, market despite earnings bouncing, especially back in small cap and mid caps. So I would say a market which remains pretty much volatile, a market which remains, sideways, but a stock picker market. Market moves very fast in the pockets which have underperformed in the recent past. So hence, when we are highlighting to our institutional investors, what we are highlighting to them is to maintain or reduce their underweight positions in IT. That has been our call for the last month and a half. Banks, we are expecting earnings estimates downgrades. Banks have done also very good in the last 1 year. So IT over banks was one of the calls. Stay in large caps, stay in Nifty, very well knowing that the last 3 months, Nifty hasn't performed as good as what the small cap or the mid cap has performed.
All right, indeed, interesting take, specifically coming in on the IT as well as the banking space. We'll definitely watch out for that. But Nitin, also help us understand what do you make of the Q1 update so far, especially for the FMCG staple side as well as the banking side as well. Because for staples, have they surprised you in any way? Because the stock reactions were actually quite good. And also on the banking, like you just highlighted that you are expecting the earnings downgrade or rather cuts coming in. But what's your take on Kotak Mahindra Bank? The stock is up today and I believe that's one of your sell ideas.
Yes, we've been sellers on Kotak for a while. I think what Kotak, I was speaking to the analysts, and what stood out from Kotak results perhaps was, the kind of specific credit categories in which they approached the growth. Perhaps as a sector overall, we are worried about that the deposit growth, which has actually come up. We're not getting a similar sort of a credit growth in the marketplace. Perhaps the pristine credit quality which most of the banks were seeking in the private sector isn't available that much. Post-COVID, a very good amount of credit rush that came through. People who are good quality credit are not borrowing that much anymore. Perhaps either their incomes have moved up or they're all cash rich, like most of the corporates in India sitting on a 5 trillion market, 5 trillion rupees cash. I think there is a demand for credit in the MSME, in the SME, or in the middle or the bottom of the pyramid. Are the banks geared for that? That is the key question. Some of the NBFCs may be doing a good job over there, but I think the banks are finding themselves the pristine quality credit of either private consumption or, for that matter, corporate staffed, I would say. Coming back to your question on the FMCG, clearly, yes, GCPL update, perhaps some signs around the real wage growth, some readings around the freight index in the long distance for trucks in India is showing that there could be a small, let's say, a blip or an improvement in activity in the fortunes or the activity at the rural or the agri-based economy. And given the food inflation which has come off, perhaps that shows a positive impact in the real wages also. So looks good. FMCG and IT in a market where flows are, as I mentioned in the beginning, the mutual fund flows are sort of decelerating, earning estimate outlooks, especially from the banks, are not looking that robust. People could be forming a view that IT and FMCG, more defensive sectors, earnings are stable, no more cuts possible over there. And hence, the two sectors outperforming. IT has been one of our recommendations. It could see no more cuts, perhaps going into or perhaps into this fiscal. So FMCG, clearly something to watch out for right now. Is this improvement a beginning of a big trend? We've seen some false starts in the past. Let's see how it builds up.
Well, indeed. But Nitin, within the FMCG basket, any stock that you can talk to us about, given that we already have your top buys and top sales? So anything that is looking interesting to you? And with respect to the valuations as well, are they comforting at this point in time? Because they haven't done anything for the past couple of years, if we see.
I think you're right. FMCG as a sector valuations have remained rich. But remember, in our country, the lot of valuations are a function of flows. Also, I'll keep on going back to that. And the mutual funds, the institutional investors, they continue to own these names because these are considered to be quality companies. I think a few names that we like, maybe more like the Indian domestic companies like GCPL, we would like them, but not going into a specific stock discussion, please.
Interesting. I was also looking at some of your other top sells. Highlight for us, where is it, Nitin, that you don't see any valuation comfort now and you think valuations are at their peak and it makes sense to actually book profits, if not completely exit?
I would say the same. When you look at the sectors again within the IT, where we like IT as a space, there could be some of the mid-cap IT companies which are perhaps very punchily priced for the quality of the business. Like something like a Coforge could be one. Something like a Persistent could be another one, where we think that these are really, really punchily priced. At the same point in time, there could be stocks like DMart in the consumption space, where we find them very, very punchily priced, would remain away from such names. And at the same point in time, I would say even consumer durable companies like Voltas, which appear to be very punchily priced and perhaps stuck in a very, very highly competitive zone where they're unable to create value from the one business of consumer durables that they are in, or in the projects business. Those are the 3 or 4 names that stand out. But at the same point in time, in the banks also, we've highlighted before, names such as Kotak, etc., are the ones. What we don't like is themes like, I would say, defense today, which is like a talk of the town. There could be stocks such as Godrej real estate, punchily priced. Again, I would say so, though the real estate sector holds up really well. So those are the 5 or 6 names which come to my mind as one of the key sell ideas that we would have from our basket today.
Okay, I want to go back to FMCG again, and this is my personal view, which is that if you buy stocks which have 4-5% growth and sectors which are growing below the GDP and the P multiples are 50-60, how will you make money?
Very interesting. I think if I were to go into such mechanical ways of valuation, I think it would be very difficult to one to say that where will we make money. But as again, I go back to that. These are core holdings. These are defensive stocks, FMCG, and people are perhaps owning them for a shorter periods of time, overweight or underweight. But again, let's go back on the similar principles that if you look at many of these defense companies also in India, which are fairly very large, expensive companies, they're trading at more than 50-60. Even EMS companies like Dixon, which we have a sell on, one would actually say that they can grow much faster, but their valuations are perhaps in excess of 50 times, 60 times again. Perhaps it's the mood change is what the market is looking for in the case of FMCG. The mood change for earnings growth trajectory. Remember, one is the valuations, but the other is what is the earnings expectations. And the market sometimes follows, or most of the time in the short term follows, the earnings expectations trajectory. And perhaps FMCG looks like one where the downgrades are behind us, and there is a possibility of some minor upgrades in the near term. Let's see whether it builds up into a bigger trend.